So in previous lecture, we discussed about different threats on auditors' independence. And there are 5 types of threats that appears on auditor independence. We try to reduce them to an acceptable level. If we are unable to reduce them, we should avoid not performing that activity. Self-interest threat arises due to personal interest, due to financial interest, due to fee dependency, due to undue hospitality, due to referral fee or commission-based fee, due to contingent fee or percentage-based fee, due to client-based remuneration, due to conflict of interest, or due to litigation with the clients. I mean, these are the situations, these are the examples where auditor is facing a self-interest threat in a scenario. If we are finding any information about these situations, so we'll highlight self-interest threat. Self-review threat arises where you have performed any work that you are going to review during the audit, that you are going to check during the audit. So ultimately, if you have performed anything during audit, you will not perform detailed procedures to check that. You will perform lesser procedure. Instead of audit, you will just review that account balance. That's why it is called self-review threat. And due to this, mainly your objectivity will be affected. Self-review threat arises if you have provided accountancy bookkeeping services to the audit client, due to taxation services, due to internal audit services, due to asset valuation services, or due to secondment of staff. Advocacy threat, also called management threat, arises when you, being auditor, are going to perform any of the other function that is of company management. Like you are going to represent client company in court case, not on the request of court, on the request of client. You are representing a client in share issuing. You are representing client in obtaining bank loan. I mean, you are negotiating with bankers on behalf of company management, or you are going to represent company to tax authorities to resolve tax dispute. An advocacy threat arises due to advisory services, or you are involved in client staff recruitment. Familiarity threat arises due to long-standing relationship, due to family relation, due to closer friendly relation, or due to undue hospitality. How we can reduce this? The auditor who is having long-standing relation, who is having a family-friendly relation, we should not assign him to the audit. We should assign other auditor. Intimidation threat arises due to any pressure imposed on the auditor, any fear on the auditor by client management or any third party. And we should not work under any of the pressure, any of the fear. We should try to resolve. If still unresolved, we should withdraw from the engagement. Intimidation threat also arises due to lowballing. The fee pressure could affect your audit objectivity. Intimidation threat arises due to second opinion. If client is pressurizing, threatening, I will go for second opinion. So intimidation threat arises. So we need to resolve this by discussion with client management. If still they are having option of second opinion, we should resign from the audit. So these threats we have discussed. And chapter 3, we have covered. Let's discuss some questions on ethical issues. In our exam, examiner asks questions relating to ethical and other professional issues. In this chapter, we are just discussing ethical issues. After this, we will discuss some professional issues. And then from past paper, we will practice some questions, a mixture of ethical and other professional issues. So question number 3 we are having for 15 good marks, and there are 3 different parts of this question, 5 marks each. Consider the following scenarios and reach a conclusion on the appropriate course of action. Whenever we are going to describe any threat, we should always provide mitigations as well. I mean, how this threat can be managed, how this threat can be reduced or avoided. We should always provide mitigation. Without mitigation, our threat explanation is incomplete. Examiner will not award any of the mark. Can you identify any of the issue threat in part A? Part 5 marks. So during the course of your audit of a BMW dealer, we are conducting audit of BMW. You notice a payment of an entitled discount to the managing director of another client. We are auditor of BMW and we are auditor of any other client, say ABC company. We are auditor of both. And BMW sold a car to ABC company. This means ABC company have recorded purchases and BMW have recorded sales of a car. You notice a payment of an entitled discount to the managing director of another client. They have provided discount. BMW have provided discount on the car purchase. Might be they have recorded a sale with $90,000. The full price was say 100,000, but they have recorded sale with discounted price 90,000. On investigation, you find the company paid the full list price for the car while they have recorded purchases with 100,000. Which company financial statements are wrong? ABC. They have recorded purchases of 100,000. While auditing BMW, we realized they sold cars on discounted price of 90,000. Now there is an issue of a fraud as well. Might be that managing director 10,000 he took from the company account and put into his pocket, and 90,000 he paid to BMW. And he recorded purchases with car asset with 100,000. Not purchases, they have recorded car asset, in fact. As they sell cars, so they have recorded sales. This means ABC company assets are overstated by 10,000. We know. In fact, we are having evidence. But can we disclose this fact? How we are aware about it? Through audit of BMW. If you don't audit BMW, we could not find that the car is overstated by 10,000. But now we are aware car asset is overstated by 10,000. How? Through audit of BMW. If we qualify audit report of ABC company, assets are overstated. We need to explain the reason in basis our opinion. What reason we will say? The car is overstated by 10,000. What is the evidence? Because we were the auditor of BMW, that's why we are aware that the car they bought on 90,000 but have recorded 100,000. But through this, we are disclosing confidential information of BMW. So there is a conflict of interest. And we cannot say easily the car is overstated by 10,000 because we found evidence from BMW audit. They recorded sale 90,000. They sold cars on discounted prices and they have recorded on full price. We cannot say because through this we are disclosing confidential information of BMW dealers. Might be they have provided discount on personal relation. And company have recorded 100,000 and that 10,000 moved into managing director pocket due to his personal relation. But even if he is receiving on personal relation, any benefit, he need to disclose in the financial statement. If there is no disclosure, again, financial statements are misstated, but we not highlight this fact. That's what we need to do. What could be the course of action? Because if we disclose this, ultimately we are disclosing confidential information of BMW and we are working in self-interest threat. And we are considering best of ourselves rather than other clients. So what is the course of action? We should discuss with ABC company confidentially. Like through audit of BMW, we are aware the car price is 90,000 rather than 100,000. So please restate the financial statements to the discounted price, so that we should not move towards qualifying report. But if we do not restate the financial statements, then we should take legal opinion. We should take legal opinion. And if still there is issue, we should consider withdraw from the engagement. Because we cannot breach confidentiality of any of the client. Because this is not legally required. This is not court required. This is not disclosing in public interest. This is not even in auditor professional interest. Because professionals say you need to maintain confidentiality of the client. This is not BMW fault, like you are disclosing their confidential information. So we should consider legal advice, and still unresolved, we should withdraw from the engagement. Not an easy part. But we are learning how to tackle different issues. Part B, the very simple. Yes, there is a familiarity threat. The husband of your most promising manager, audit manager, because we are running audit firm, appointed as finance director to your largest listed client. So there is a familiarity threat due to family relation. Not only familiarity threat, the audit manager is going to check the work of her husband. So she will not highlight his weaknesses, otherwise might be he will lose job. So there is a self-interest threat as well due to personal relation, personal interest involved. Not only familiarity, self-interest, the husband could pressurize his wife. Do not disclose these things. So there is intimidation threat as well. So whenever we are going to discuss any of the threat question, we will always put a heading of the issue. The issue here is what? Family relation. The issue here is what? Family relation. Previous question, what was the issue? Conflict of interest. Under conflict of interest, we explain there is self-interest threat. Here we will highlight the issue, family relation. Under family relation issue, we will highlight there is a familiarity threat due to family relation. There is a self-interest threat because the manager is going to audit his husband work. And there is intimidation threat because husband could pressurize the wife not to highlight the weaknesses. So what we should do? What should be the course of action? This audit manager should not be part of the audit team, and other manager should have been assigned to the audit of this client. As well as second partner independent review of working paper should also be performed, because the team that is going to audit, they are colleague of that manager. So work could be compromised due to colleague relationship. So second partner independent review of working paper should also be performed. Are you with me? So we have learned if there is any family relation, what things we can discuss. Can you treat this part C as well? You have been the auditor of a company of which your godfather was the major shareholder. He recently died, leaving all his share to you. I mean, those shares you got as a lottery. So now you are working auditor, being a shareholder of the company. So there is a financial interest due to shareholding. Being auditor, we need to see true and fair profit. While being a shareholder, you will try to see best profit. So that could affect auditor independence and objectivity. What auditor should do? If you want to keep shares, you should resign from the audit. And other auditors should audit this client. But if you want to continue audit, you need to dispose of shares. And while disposing shares, care must be taken. Shares should not be disposed of in a sensitive time. Sensitive time means time immediately before issuing financial statements and immediately after issuing financial statements, because this is the time where there is too much fluctuation in company share price. So if you want to continue audit, you should dispose of the shares, and care must be taken. Shares should not be disposed of in sensitive time, and the audit work should not be performed until the shares have been disposed of. Proper mitigation. 5 marks are there. Though there is one threat, but how we can cover 5 marks, we need to provide more mitigations. So we are learning how to tackle different issues, what point we can discuss in one issue. And we are having one more question, question number 4. Advise Gladys of the ethical implications. There are ethical implications, mean issues, in more than one issues. Of her instruction, mean you need to discuss ethical issues along with course of action, each by each separate, and propose a suitable course of action for her. And then we need to propose the course of action for Gladys. Try this question on coming.
We are given everything. And then we can check the target call. We need that target call in the yeah. But we have the target call. It's the what once we get down to the you compare it with the actual R and actual R. The treatment is not the formula. Action. Then everything it is not target to solutions. We all the food I want to do to please something. But then I think think of the we do for the I will how we can be the regarding that problem will happen. The Canadian information and then right now, we can 2.5 I think you like me in my list. We are not really after the how the thing. We will then I can promise the people. I can usually both not the cost. Sometimes we can contain or delay itself in the game in better quality. If the building will be playing that work to be in this of in the law, profit will answer again. We are first one of that. Because that difference between target cost and actual order price. So basically we are very much focused on the okay. That's the category of the Okay, let's read it now. Go to the deployment. Let's read it now. Here is the bottom capital and all product in market in correct the law so with not that we are one to that how we calculate the private and county army is not for the staff. Army and its liability is complete. How to be for the power. If you be
So what's drama going on in this question? Glady is a newly promoted manager in Prince and Company. So Glady is audit manager in Prince and Company, a large UK accountancy practice. So she is a manager. She has recently been approached by her brother-in-law Barney, who is the financial director of radiosoftware.com, a rapidly expanding listed company specializing in accounting software. If you look at these three lines, there is no issue. She is working as audit manager in a firm. Her brother-in-law is approaching for what purpose, we don't know. But he is a finance director in radiosoftware.com, and radiosoftware.com is a listed company and is expanding their operations. The company has recently acquired a financial services company selling insurance and investment packages, who radiosoftware.com, because they are growing their business. The company has no experience in financial services, so this is their issue, not our issue. If you see there in first paragraph, there is still no issue. There is still no issue. Don't know whether they have asked to become auditor or not, but still there is no issue. There is information like audit manager, brother-in-law is a finance director in radiosoftware.com. Okay. Barney has asked Prince and Company audit firm to become the auditor of the group, replacing the existing auditor with whom there has been disagreement over accounting policies. Now there are two issues. First, if Prince and Company become auditor of radiosoftware.com, so due to family relation of Glady and Barney, there is a familiarity threat. There is familiarity threat. You could say there is intimidation threat as well, because brother-in-law could pressurize sister-in-law work. So auditor independence objectivity will be affected. If radio software is becoming client of Prince and Company, Glady should not be assigned to the audit of this client. And other audit manager should have been assigned to the audit. And a second partner independent review of working paper should also be performed. So due to family relation, there is familiarity threat. So we have explained this. Now there is another issue. They are going to change their auditor. With the previous auditor, they are having a disagreement over accounting policies. This means those disagreement could arise with us in future as well. That could force us to resign from the audit as well. So what we should do? We should obtain professional clearance. We studied this topic, professional clearance, very first day, procedure before accepting audit. I mean, we should contact the existing auditor to ask reason behind leaving the audit, because if the reason is relating to accounting policies application, so that reason could also affect our work in future as well, could force us to resign from the audit as well. So that's why we should contact the existing auditor and ask him the reason. So this is second issue. Is that? Let's see. He is concerned. Who? Barney. He is concerned, however, that Glady should supervise the audit. No, that we have discussed. There is family issue. And not another manager. Prince and Company, mean audit firm, has little experience in the audit of financial services company. They haven't conducted audit of this kind of company previously. So there's the issue of professional competence as well. Ethical, codes of ethics, ethical issue, not threat, ethical issue, professional competence. Like company audit firm doesn't have experience of auditing this kind of a company in past. So if they want to continue audit, they should assess skills, experience, and knowledge in the staff. Either they need to be trained or they need to recruit the skilled staff. They need to consider that. Three issues we have discussed. Is that? Glady suspect that Reggie, a partner in the firm, Prince and Company, is having an affair with Primrose, Barney's wife. Mean his brother-in-law wife could be her sister. Exactly. Is having affair with Reggie, audit firm partner. So we can say this is what close friendly relation. Of whom? Firm partner and client wife. So due to that, there could be familiarity threat. Is there? Due to relation, close friendly relation, familiarity threat is there. He could influence auditor work with through his wife. Is that? And if he is not aware about the affair, then he could pressurize the firm, the partner. So there could be intimidation threat as well. Affecting auditor independence objectivity. What should be the course of action? We should request Reggie to stop this kind of affair with client if client is important from point of view. Because this is not professional. If we want to continue with audit, if this client is important for our firm and we want to continue with audit, we should instruct Reggie not to have these kind of relation affairs with client. It could affect future relation with the client, either through independence or either there could be some issues with firm and the financial controller of the client. So we should request or instruct Reggie. Because to client, we cannot say control your wife. No, we can request or convince our partner not to have these kind of relation with the client if the client is important from point of view. Is that? Okay, Barney strongly wishes the firm to take on the audit of the group. Might be he's not aware about the affair. That's why he is strongly wishing. And his consequence has been sending regular gift of champagne, fresh salmon, and theater ticket to the senior partner of Prince and Company. Probably he is not aware about the affair. That's why he is sending this undue hospitality. Undue hospitality is that champagne, food items, and theater tickets, entertainments is creating a self-interest as well as familiarity threat affecting independence of the objectivity of the auditor. So what should be the course of action? The firm should request the client. The client which can request, please do not send this kind of hostility to the audit staff, and the audit staff should be instructed not to avail this kind of hostility from audit client. Audit staff not requested, instructed, but client we can request. So how many issues? 1, 2, 3, 4, 5. There are 20 marks. Each issue we are discussing about 2 to 3 marks. Okay. The senior partner aware that the firm is currently short of business. The client is very important from firm point of view. Has ordered Glady to oversee the nomination and appointment and to supervise the audit. Because we should go as per client wishes. They want Glady should supervise the audit. He has indicated that if a good relation is established, her prospects of a partnership in the firm will be greatly enhanced. Her promotion, her remuneration is based on this client. So we can say client-based remuneration or promotion. Creating what? Self-interest threat, not only self-interest, intimidation threat as well. Pressurizing your work because this client is important for my promotion, for my remuneration. So what should Glady? A firm should not associate this kind of client-based remuneration or promotion to audit staff. For manager, these client-based remuneration are acceptable if not significant. But in this case, there is significance like promotion. But for engagement partner, strictly prohibited. There is one more issue. Firm is currently short of business. There could be fee dependency issue because that client is what? Bigger client. They are expanding their business. And firm is short of business. They are struggling. So the fee coming from this client could be 15% or more of firm's annual income. So that will create self-interest as well as intimidation threat. So what firm should do before accepting the client? They should perform fee projection. Fee projection mean fee from one client, this client should not be more than 15% of firm's annual income. How many issues? 1, 2, 3, 4, 5, 6, 7 issues we have discussed. But answer is incomplete yet. Advise Glady of the ethical implication of our instructions. So ethical implications we have discussed. Each issue along with their safeguard mitigation. And propose a suitable course of action for her in what she should do now. So now we will put course of action for to Glady. The partner forcing her to supervise this audit as per client wishes. So what Glady should do? She should communicate all above issues to senior partner in the firm. These are the issues relating to this client. And she should avoid supervising audit of this client. If still she is pressurized to supervise as per client wishes, she should resign from the firm and report to professional body. Now we'll be able to tackle 20 marks from this question. We're learning how to deal different type of question, how to discuss issues. So one issue can be discussed for minimum 2 marks. In 1 point for threat, 1 point for mitigation. In some issue, there could be 5 marks even. Like we have covered question 3, because there were more threats involved. Explaining each threat will be having separate mark, or there could be more mitigation. Explaining each mitigation will be having separate marks. Otherwise, for minimum, we can discuss one issue for 2 marks at least. One for identifying and explaining a threat. Explaining mean it could affect auditor independence objectivity. And one for the mitigation, how this could be resolved. What students are doing in this paper, they are highlighting the issue, but they're not providing mitigation. They are not providing solutions. They're highlighting issues because we learned due to shareholding there is self-interest, so they are building there is self-interest threat. But these babies can do. But examiner is requiring your course of action, mitigation. Sometimes he asks separately, provide mitigation, and sometimes he don't ask separately. If he is asking separately or not asking, we need to provide mitigation. Without explaining mitigation, that threat is incomplete. Question number 5 is 15 marks. Comment on the matters that should consider in deciding whether or not your audit firm can comply with the Rosella's request. In whether firm should accept Rosella request or not. Who is Rosella? What her request? We don't know. Can you try by yourself? 15 good marks. Mean there could be more issues. There are 3 to 4 issues. By discussing them separate with their mitigation, we can score 15 marks. This question is having two separate part. Part A is a separate, part B is a separate, total 15 marks. This means you could say 5 marks are part A, 10 marks are part B. What is part A? Explain the importance of the role of confidentiality to the audit-client relationship. As per ECC Code of Ethics, we should maintain confidentiality. We should not disclose client confidential information obtained through audit relationship for any personal advantage or benefit of another party. Because we need to maintain the trust of client on auditing profession. But there are 5 exceptions where we can disclose client confidential information. If client have provided permission, if it is required by court, if it is required by law, if to disclose is in public interest, if to disclose in auditor professional interest. Is that part B? So comment on the matters. We should discuss the matter that you should consider in deciding whether or not your audit firm can comply with Rosella's request. Your firm act as auditor and advisor of Black 7 and to its 4 directors. First, there is advisory services. Create advocacy threat. Is an advisory, we are performing what management level function. Is that? So if your firm is having separate advisory department, we should provide these services through Chinese walls, i.e. separate staff. Otherwise, you should avoid providing advisory to the audit client. The company is owned 50% by Brad Capellas, 25% by his wife Minerva, and 10% by Janice Trepiano. Total 85%. Brad is chief executive and Janice the finance director. Janice's sister Rosella Trepiano has recently resigned from the executive board, following a disagreement with Capellas, those who are having 75% holding. Rosella has now formed her own company, Black Heaven, in competition with Black 7. Rosella is currently negotiating with her former co-executives the profitability remuneration due to her. Her some remuneration is still pending with the company, and the sale of her 15% holding of shares in Black 7 to one or all of them, as well as she want to withdraw her investment of 15% by selling his holding. Rosella has contacted you. Who are you? Auditor and advisor of Black 7. So she has contacted you to find out Brad's current remuneration, because might be he haven't disclosed. So you want to take some action based on the detailed information. So she's asking about Brad's current remuneration package since he refuses to disclose this to her. So there is issue of what? Confidentiality. Why she's asking you? Because you being auditor is having detailed information. So as per ACCA course of ethics, we should maintain confidentiality. We should not disclose. And disclosing here on request of Rosella, not coming under law requiring, court requiring, or in auditor professional interest or in public interest. So we should not provide, we should decline disclosing this information to Rosella. But we can instruct her, being a shareholder, she's still shareholder, she can ask this information from company. She's having a right. Or this information is also provided into company annual reports as well. So you can find from there. She's idiot. She doesn't know what right she's having or where else she can find, because company disclose this to general public in annual reports. Board member receiving what kind of salary, what kind of package, all this information is available in annual reports. So you can find this information from annual report, but we should not disclose to her. One issue we can discuss. Okay. She also requested that your firm should continue to act her personal advisor. Personal advisor. Why? To recover her remuneration as well as selling of her shares. Recovering her remuneration as well as amount of investment. That's why she is requiring personal advisory. We are also advisory. She is requiring advisory against whom? Against our client. Against our client. So there is conflict of interest issue. Is that self-interest that will arise? In one situation, we cannot provide advisory to both parties even through Chinese walls. Either we can provide advisory to Rosella or we can provide advisory to Black 7 or their directors. So if we want to accept her opinion, we should resign from the advisory of Black 7 as well as their owners, or we should reject providing personal advisory to Rosella. As a personal advisor and become auditor and advisor of Black Heaven. So auditing compactor. Again, create conflict of interest because we are having confidential information of both. So confidential information could leak out between clients through our staff. So creating self-interest threat. What we should do? We should take permission from both clients. If they agree, we can continue both with the separate staff from different offices. Written agreement should be signed with the staff not to disclose confidential information between clients. But if any of the client do not agree, we should either accept Rosella auditing, Black Heaven auditing and resign from Black Seven, or we should reject Black Heaven and continue auditing Black Seven. There are so many mitigations that we can provide. Are you with me? First advisory, then confidentiality, then personal advisory. In one situation, we cannot provide to both, even through Chinese walls. But in case of audit of two competitors, we can continue if they both agree. But separate staff from different offices, written agreement signed with the staff, audit staff not to disclose information. If any of the clients do not agree, we should accept one, reject other. And the decision should be based on financial grounds. And in this situation, if we see, might be rejecting Black Heaven audit is appropriate decision. This is new company. Black Heaven is our old client. So let's move towards chapter 4. Chapter 4 is about fraud. What is the difference between fraud and error? Fraud is intentional act to deceive other, to misappropriate results, while errors in financial statements is what? Unintentional misstatement. If fraud is intentional, there is always attempt to hide. Behind fraud, there is always attempt to hide. That's why for auditor, it is easy to detect error, but very difficult to detect fraud. Because in fraud, there is always behind attempt to hide. Regarding fraud, if we see in a company, fraud occurs at two different levels, at management level and employee level. At management level, the normally fraud are relating to misstatement in the financial statement. In preparing fraudulent financial reporting. Fraudulent financial reporting. Mean misstatement in the financial statement. But at employee level, they do not prepare financial statements. What could be the fraud? Misuse of asset. And they will misuse company asset like stealing company cash, stealing company inventory, misusing company car for personal purpose. But at management level, always, not always, but more than 65% relating to fraudulent financial reporting. Obviously, they could also misuse asset, but mainly management level, misstatement in the financial statement, preparing fraudulent financial reports. Regarding fraud, who is responsible to detect a fraud? Management or auditor? Auditor is not responsible for detecting fraud. He is responsible to express opinion on the financial statement. His duty is not to detect a fraud. His duty is what? The purpose of audit to express opinion on the financial statements, whether they give true and fair view or not. It is a responsibility of company management that they should detect a fraud. It is the responsibility of company management. They should detect a fraud. And to detect a fraud, they should implement internal control system in the company. What's the purpose of internal control system? To prevent, detect, to correct fraud and errors. And to review that internal control system, they should appoint internal auditor. He will detect fraud. Auditor responsibility is to express opinion on the financial statements. That is auditor main responsibility. Mean auditor is having no statutory duty in relation to fraud. His statutory duty is to express opinion on the financial statement, whether they give true and fair view or not, but to express opinion. auditor need to obtain evidence. Without obtaining evidence, you should not express opinion. To obtain evidence, what auditor need to do? He should perform audit procedures. An audit procedure that he is going to perform, he should design audit procedure. He should design audit procedure with expectation of a fraud. If there are any fraud, it should be detected. But the main purpose of performing procedure is not detecting fraud. The main purpose of performing procedure is to obtain evidence whether financial statements give true and fair view or not. But he should so design audit procedure with the expectation of fraud. This means we can say detecting fraud is not auditor primary responsibility, but could be secondary responsibility. Primary responsibility, express opinion of the financial statement. And to express opinion, he should obtain evidence. To obtain evidence, he should perform procedures. While performing procedure, he should keep in his mind if there is any fraud, that should also be detected. And he should design audit procedure with the expectation of a fraud. That's why relating to fraud, auditor is having some responsibility per ISA 240. We have covered ISA 250, auditor's responsibility in relation to NOCLAR, non-compliance laws and regulations. Relating to fraud, there is a standard ISA 240. What is the ISA 240? We're going to discuss later on. Let's discuss at a management level, what kind of a fraud is there? Fraudulent financial reporting. If management is going to commit fraudulent financial reporting fraud, what could be the reasons? Mean incentive and pressure. What could be the reason? There could be financial stability or profitability threatened due to economic or some other issues like companies not achieving good financial results. So what they will do to show good financial results, they involve themselves in a fraudulent financial reporting fraud. This is the reason. That's why management is committing financial reporting fraud. There could be another reason, pressure to meet the requirement of expectation of third party. The company need loan from the bank. Bank is saying your gearing should be this, otherwise there is no loan. Your profit growth should be this, otherwise there is no loan. So if generally they don't have that much requirement, so what they will do, they will produce fraudulent financial reporting. Reason behind fraudulent financial reporting could be declining performance of the company. If performance is declining, ultimately management will not be able to get their bonus, their personal reward. To get their bonus, what they do? They prepare fraudulent financial reporting. So these are the reasons due to which management is committing fraudulent financial reporting fraud. Where it is easy for management to prepare fraudulent financial reporting, what are the opportunities? And if these things are there in a company, there's always high chance of fraudulent financial reporting, or it is easier for management, they can misrepresent the results. The existence of related party transaction, where there are related party transactions, there are always chances of fraudulent financial reporting, like they perform transaction with the related party like subsidiaries to highlight the sales as well as profitability. After year-end, they will adjust with returns. Items in accounts based on significant estimate, provisions, amortization, depreciation. Through this, they can highlight profit, they can highlight assets. They can understate liabilities by creating less provision. Because this is based on management estimate. Nobody can ask a question. Instead of depreciating asset on 10 years, they are depreciating on 30 years, 20 years, so that they can charge less depreciation, overstating asset as profit. That are difficult to corroborate, mean the accounts balance that are difficult to corroborate, mean where supporting documents matching is not done, especially relating to assets if bought during the year. And complex transaction sequence in multi locations if company is performing in so many different locations. So there is always high chances of committing fraudulent margin reporting fraud. Mean they can record fictitious sale in any of the location. Use of agent or bank account in tax haven jurisdiction. What is tax haven jurisdiction? Tax free zone. Tax free zone means some areas in our country are tax free. And what companies does, they establish their branch in tax free zone and they record the sale of all other branches where in tax free zone, so that they can pay less amount of tax. And this tax evasion is also fraud. Tax saving is something different. If you are recording A, B, C, D, E branches sale in tax haven jurisdiction means Z, this is fraud. This is not tax saving, this is tax evasion. Ineffective corporate governance arrangement if company is not following corporate governance codes properly. Mean non-executive directors are not there to challenge short-termism strategies of executive directors. Financial matters are not overseen properly through audit committee because company doesn't have audit committee. So there is always high chances of fraud because there is no monitoring. Entities where it is difficult to determine who has the controlling interest, especially in case of group audit, there is always high chances of fraudulent margin reporting fraud. High turnover of accounting and internal audit staff. Because if the fraud is detected, we can impose on the person who has left the company. If not detected, that will continue. And where control system is ineffective, mean policies, procedures are not properly followed. This means frauds are not being prevented, detected, and controlled. So these are the opportunities where there is easy for management to commit financial reporting fraud. At employee level, what kind of fraud is there? Misappropriation, misuse of asset. Why employee misuse the asset? What could be the reason, incentive and pressure? What could be the reason behind misuse of asset? One reason might be their personal financial obligations are not met through their pay. I mean, their pay is too low. So how they are meeting their financial obligations? By stealing company assets. The other reason could be adverse, poor relationship between company management and staff. If you are having poor relation with staff, what staff will do? They try to put you on a loss by misusing that asset. Where there are opportunities for employees to misuse asset, mean steal inventory or cash. Where company is performing in high value inventory, gold, diamond, there is always chances of stealing inventory. Company is operating in bonds are those assets that can easily convert into cash. So there is always high chances of misuse of assets. Misuse of asset fraud chances are there where inadequate control over assets and authorization of expenditure. Mean buying assets for personal use and charge to the company. Mean adequate authorization control is not properly working. Inadequate recruitment screening process. What does that mean? Recruitment screening process nowadays. While recruiting anybody, companies are requiring 2 references. Why? So that in future, this person left the company or disappear after committing any fraud, we can trace through the people who have provided references. Not only they are requiring, they are confirming from those people, you know this person. So if company haven't obtained any of the references, this means for employee, it is easy to disappear after committing fraud and he will not be traced. Inadequate access control over automated records. Mean if company system is computerized and access control to the computerized system is not authorized properly. It is easy for the staff to steal any asset and remove from the system. If it is not in record in the system, nobody can identify where that asset. That asset will be, fraud will be identified if it is in the record, but not physically there. If it's not in the record, they have removed because they are having access to the system. They can steal, they can take that asset to their home. Nobody will detect that. Circumstances indicating the possibility of a fraud in a company during audit. If you are finding these circumstances, so there is always high chances of fraud you need to consider. A poor control environment. What is control environment? Attitude of top management, where company top management is not following policies, procedures for themselves. Nobody will follow policy procedures in the company because all the employees working under leader to whom they follow leader. The way leader is behaving, the followers behave like that. If there is poor control environment, top management himself not following policy procedures, this means staff is not following policy procedures, there is always high chances of fraud. Discrepancies found in accounting records. In accounting records, not kept properly. For some transactions, we haven't found any accounting records, so there is chance of fraud, even money laundering as well. Conflicting or missing evidence. There is sale recorded. There are no sale invoices available. Sale invoices are available, but there are no dispatch note. Dispatch note are there, but no order document. So there is chances of fraud. Problematic relation between auditor and management. If client management is not facilitating the auditor in providing evidence, in providing information, if auditor asks for evidence or information, they are saying, okay, please come next week, we are too busy. Why you are asking this information? We are not there to help you. We are performing on work. We are having so much pressure. So this means there could be chances of fraud. Audit procedure in relation to fraud and its detection mean what auditor should perform if there is a high chances of fraud. Audit problems. What auditor facing problem in detecting fraud mean why auditor is unable to detect a fraud properly. The nature of evidence available is limited. This could be the problem. Auditor cannot detect a fraud because to detect a fraud, he need to perform detailed procedures and evidence are limited. You cannot detect a fraud properly. Investigative power are limited. We are auditor, not a policeman. So that's why sometimes auditor unable to detect fraud properly. There is no legal requirement for the disclosure of a fraud. If company haven't disclosed any of the fraud and we are performing procedure on sample basis, we are not verifying 100% transactions. And the transaction that we haven't checked, fraud is involved in those transactions. So there is a limitation, auditor cannot detect fraud. The concentrates on reporting can be exploited by fraudsters, mean behind fraud, there is always attempt to hide. And there is a proper attempt to hide, it is difficult for auditor to detect a fraud due to time constraints. And investigatory fraud being a heavy cost, ultimately to investigate fraud, we need to perform more detailed procedures. We need to pay more to the staff member, and we are charging a little bit audit fee. So detecting fraud incur through cost. So due to cost pressure, we do not go into more detail to avoid extra cost. This could be another reason auditor unable to detect all frauds. In why auditor unable to detect all frauds? Why auditors sometimes cannot detect a fraud? The nature of evidence is available is limited. We don't have investigative power to investigate fraud. It is not legally required to disclose a fraud in the financial statements. If it is not disclosed, not coming into our knowledge, There could be some constraints. There could be cost constraints as well. For ISA 240, what audit procedure auditor should perform if there is indication of a fraud? If there is indication of fraud, what audit procedures auditor should perform? If there is indication of fraud, means chances of fraud. We realize there could be chances of fraud. We should increase our professional skepticism. In critical nature, we should increase. We should not rely on the evidence obtained. We should try for more and more evidence that we can take. Not only we should emphasize all the staff members to increase their professional skepticism because there is chance of fraud. Changing audit approach. Instead of requesting written confirmation, we should move towards oral confirmation. We learned documentary evidence is more reliable than oral. But in case of fraud, you should not go for written confirmation, go for oral confirmation. Oral means personally visit the customer, personally visit the bank and take the information rather than sending information through letter or email. Because those letter or email could be replied from the client management, client staff. So that's why we should personally visit. From where we want to get confirmation, we should personally visit, ask, and then write down over there and take their signature. Rather than while sitting in the firm, we are sending email or letter and receiving replies, confirmation. No, we should personally visit. In case of a fraud, we should not inform the client when we will perform the procedures. We should perform procedure on surprise visit. If we are informing the client, okay, 3 days after today, we will come for checking this area, then everything will be okay over there. So perform procedures on surprise visit. And requesting inventory to be counted at the period end day. If there are some account balances that we need to check at the final day of the year end, like inventory, cash at bank, cash in hand. Because the figures appear in financial statements are of a final day of the year end. At 31st December, we are having this inventory. So at 31st December, we should go and count the inventory, whether this inventory is available in warehouse or not. Sometimes clients say, oh, this is our Christmas week, if the year end is 31st December. So could you please count inventory after year end or 2 weeks before year end? If client is honest, there is no chances of fraud. Their control system is strong, so we can accept a client request. We can count inventory either 2 weeks before year end or even 1 week after year end. But if there is a high chance of fraud, we should not accept these kind of requests. We should always count inventory at the final day of the year end because there is chance of fraud. If there is chance of fraud, we should review the year end adjustment in more detail. In some time, company performs some year end adjustments, bad debts, depreciation, provisions. So we need to review in more detail because there could be chance of fraudulent financial reporting. And if there are high chances of fraud, we will perform substantive analytical procedure. What is substantive procedure? Substantive procedure, detail work, checking account balance in detail. Analytical procedure means comparison of current year data with the previous year or with budgets of the company. That is called analytical procedure. If there are high chances of fraud, before moving towards performing a detailed procedure, first we should perform analytical procedure. I mean, we should compare current year figure with previous year. If there is a change, we should ask the reason why there is change. Now that reason, while keeping in mind, we should perform substantive procedure and see whether the change is due to that reason only. This is what performing substantive analytical procedure mean. Performing analytical procedure before substantive procedure mean detailed work. So that first you should find the reason behind the change. of figure as compared to previous year. Now perform detailed work and find the change is due to that reason, not due to other reason. If there are high chances of fraud, requesting other auditor involving in the subsidiary to perform more detailed procedures. Being a parent company auditor, we should request the subsidiary auditor as well to increase their professional skepticism. If there are high chances of fraud, we should always consult independent expert in valuing asset and inventory. If there is a high chances of fraud and client system is computerized, so using CAS, computer assisted audit techniques, mean audit software, we should move for verifying 100% transaction. Because through audit software, we can verify 100% transaction. In manual, it is not possible due to time constraints. But using software in computerized system, we can check more and more transaction. We can even 100% transaction check. If there are high chances of fraud, we should seek more external source of evidence, mean more reliable evidence. So these are the procedures as per ISA 240 that we need to perform if there is chance of fraud. Increasing professional skepticism. Instead of written confirmation, go for oral confirmation in personal visit and obtain confirmation. Perform procedure on surprise visit basis. Inventory should be counted on year end only. Year end adjustment we need to review in detail. We should perform substantive analytical procedures. And if in a group audit, we should request subsidiary auditor to maintain their increase their professional skepticism, increasing their sample size. We should obtain independent expert opinion regarding valuation of inventory and asset. If system is computerized using CAS, we should move towards 100% checking. And we should seek more external mean reliable evidence. If we have detected fraud during audit, to whom we should report? First, to management, those charged with the governance, mean audit committee, board and audit committee is got those charged with the governance. To correct in the financial statements, how in writing? In writing mean through letter of weaknesses. Mean these are the issue. Please correct like this mean will provide controls in letter of weaknesses as well. If they haven't corrected, to whom we should communicate? Then we see if there is a material misstatement, we should communicate to shareholder by qualifying audit report. Though confidentiality, we need to observe. But in case of fraud, if the fraud is relating to any money laundering issue, so we should report to third parties. Mean it is not our duty to report to third parties, but in case of some legal implication like money laundering, we need to report to third parties as well. Question number 7. There are 3 requirements, part A, part B, part C. Altogether 25 marks question. Part A. Distinguish between fraud and error. What is fraud? What is error? We can define. And comment on whether the matter in question are suspected fraud or error. In question, there are some matters. 1, 2, 3, 4. We need to identify whether they are fraud or error. You are responsible for the audit of suspect. A company is dealing in large, heavy-duty industrial vehicles. During the audit, you have detected certain matters which could indicate the existence of fraudulent activity within the company. The matters are as follows. Can you please identify whether these 1, 2, 3, 4 point are fraud or error? And this point is relating to this as well. Number 4. The first one, vehicle amounting to £6 million and included in current assets in balance sheet because company deal with vehicles. So it could be inventory, is recorded in current assets as inventory in balance sheet, but cannot be located, but physically those vehicles are not there. You have been told that these vehicles have not been sold, but management cannot give an explanation as to their location. But they are unable to give any explanation where they are located. Might be they are finding information, might be some recording is not done properly, could be sold but not adjusted, or this could be purchased, recorded into the inventory ledger but haven't reached to the company warehouse yet, still in transit. So this could be fraud or could be error. If the goods are still in transit, haven't received a company, but on the order basis, company have recorded the inventory purchases. So could be error, could be fraud. Number two, sale have been overstated in the financial statements by £8 million. So this overstatement of sale could be due to cut-off errors. In next period, sale have been recorded in current period, or could be deliberate overstatement of sale, mean fraud, to show good profitability. Number three, 25% of the vehicle held for sale have been acquired from a supplier under a special financing arrangement. Special financing arrangement. Suspect has obtained further separate finance on these vehicles, mean company have provided those vehicles as a security to obtain further debt. If you have already some assets under security financial arrangement, now you are moving towards double financing on the similar asset. And the asset that you are going to put as a security, you are aware whether it is your ownership or not. So this is clear indication of fraud. Might be there is some cash flow issue to resolve that, company need debt. That's why they are moving towards double financing, mean breaching debt covenants. Because double financing company cannot make. If you have secured any of the asset, you cannot put that asset for security again. So this is fraud. Number four, the receivable and payable ledgers and the 10 bank accounts maintained by the company have not been reconciled with the control account for the last 5 months. Okay. While reconciliation must be performed on monthly basis, but they are not performed. The last time it was attempted to reconcile, mean 5 months ago, these to reconcile these records, material differences were found. But there has been no action taken on these differences. In those differences has not been adjusted. This means there could be differences current as well. Mean records, receivable, payable adjust could be misstated. The finance director has been on gardening leave for the last 5 months and is presently out of the country and is therefore not available to discuss the matter in question. So it could be like in absence of the finance director, controls are not being properly followed. So there could be chances of errors. But as on previous differences, there was no action taken. So might be management deliberately not want to adjust the differences. So this is indication of fraud as well. It could be fraud, error, both, because in absence of finance director, controls are not being followed. That's why the reconciliation were not performed and balances were not adjusted. So, but 3 is clearly fraud. Part A for 6 marks we can discuss. Part B. State the respective responsibilities of management and auditor in respect of prevention and detection of fraud and errors. Straightforward. Who is responsible? mainly management. They need to implement internal control system, and to detect, they should appoint an internal auditor. Auditor is not responsible because his main responsibility is give opinion. But to give opinion, he need to perform procedures, and procedures should be designed with the expectation to detect a fraud. His secondary responsibility is to detect fraud, not primary. Part C. State the further consideration you would take into account in relation to each of the above matters and the issue you might raise with management. State the further consideration you would take into account, mean what you will check, what you will perform, mean we need to write down audit procedures for each matters above. The first matter was vehicles not located but recorded in the records. So we should discuss with management regarding the 6 million pound difference of physical inventory as well as recorded inventory. If still they are unable to provide any evidence, we should ask the management to restate the inventory to 6 million. We should perform cut-off testing as well. We should perform cut-off testing. Might be this is purchases relating to previous and have been recorded in current year, and that was sold in previous year. So we should perform cut-off testing as well. Number 2, sale was overstated by 8 million. So we should perform cut-off testing to verify transaction have been recorded in the correct period. Then we should discuss with management the reason behind overstatement of sales. If there is no evidence, we should ask the management to write down the sale by 8 million. And for 25% of vehicles, we should discuss with management the reason behind double financing to see if appropriate. And we need to see if there is any covenants breach due to double financing, whether company have created provision in the financial statements or not. Because in case of breach, ultimately there will be fine penalties or you need to pay back the amount. So there should be provision in the financial statement. And why company is doing this? Due to going concern issue. Regarding going concern, what we should do? We should review cash and profit projections for next 12 months. We should review latest board minutes regarding the issue. And for number 4, reconciliations were not performed. So we should reconcile by ourselves. We should re-perform the reconciliation of receivables, payable ledgers, and bank account to highlight the differences. We should discuss with the management to adjust the differences highlighted. And we should request the management to arrange replacement of a finance director until the main finance director is on leave. Because if due to his absence, controls are not being followed, so we should request the management to arrange a replacement of finance director until he is on leave. And we should re-perform, highlight, find the difference, discuss with management to adjust the differences. Let's take a break. After break, we will discuss another topic.
And there are of the higher level of and then immediately to the lower level, which was about improve the portion of the body. Second group is the bottom of the which means lower level managers are involved in setting up and kind of now creating right? These are the two main approaches. How do you look at how things on the increase level? The first measure is to be calculated on a measure. Something we get a better, all the things one, one, study, here, educate, study. Multi-level dinner, people saying, product, how to take it. Yes, we have two of us, A and B. We have to walk through, we will identify how we can stop doing, and do how we can stop. This is between any product, A, A, as in the different price of $2, we have a different price of $3, 5,000 times 2, we will get $10,000, 2,000 times 3, we will get $6,000. This is what we call sales budget. Sales budget. So we have to let me that and yeah, and okay, so we can read this and review. Well, why do we get paid? Paying for the clear of the GPT, 5,000 dollars, 1,000 dollars. Planned training programs are in 2000, right? Now we can do it in the future. So 2000, you will take that. So that's the name, right? You tell me, how many units are available? Here is our target unit. Here is explain planning drive. Planning drive is it is 95. How we can calculate stable now? Thinking multiplied by 5,025. The same way 1,000 multiplied by 130. And if you want, you can calculate that. You will have 11. If the total is really basic after the planning production, when you have the program everything. Next one will be production. From here, I have production of the first is the yard of the production. We did looking at this, how much we invest in the it's long of the next only invest in the look at what the name is. That is that we already have invested. It's really very important. Because we also let's say, and want to tell how the government is. After looking at the 1,000. The building requirement 6,000 and 5,000 units I want level. 1,000 units I want access to new stock. It's considered to be 6,000. So out of 6,000, how many units are already the stock? Is all you go in the each unit is not already. 5,200 units to be 5,200. So let's look at it in The production burden here and employment in like and easy. We are going to do working right.
Okay, moving towards chapter 5. That is professional liability. Professional liability, if auditors have expressed inappropriate and wrong opinion due to his negligent work, he haven't obtained proper evidence, he haven't performed procedures as per standards, and due to wrong evidence, he have expressed wrong opinion. He said financial statements give and fair view, and after that, it was proved auditor were negligent in checking the financial statements, and his opinion is wrong. Whether auditor need to pay damages of other parties who have made a decision on auditor opinion or not. In case of negligent work, whether auditor is having any liability, if he is having any liability, to whom he is having liability, for which parties he need to pay the damages. So professional liability. In case of negligent work, what is the auditor's professional liability? To whom he is liable to pay damages? If we look at professional liability, auditors are having two types of liabilities. One is a statutory liability, according to statutory law, and other is a common law liability, according to common law. What is the difference between statutory law and common law? Statutory law and common law. Statutory mean according to statute, mean the rules that have been predefined. You need to comply. Fines, penalties are predefined. If you don't comply, you are committed guilty. You will be fined. You will be paying damages according to predefined. Common law, the things that are not predefined. The decision will be as per the court case, as per the precedence, as per the past court case or as per the current court case, if this is of different nature. According to statutory law, auditors are having two liability according to civil law and criminal law. Civil law between parties, while criminal according to legal provisions you haven't complied, there is a criminal punishment. According to civil and criminal law, by profession, auditor is officer. Auditor is what? Officer. And if any officer is providing wrong information, wrong reports, he is assigning wrong, false statements, so he will be in imprisonment up to 7 years. According to civil and criminal law, auditor is by law what? Officer. And if any officer is providing wrong information, signing wrong accounts, providing wrong statements, so he will be facing imprisonment of up to 7 years. This we don't need to cover. We need to cover professional liability according to common law. Under common law, auditors are having two types of liability. One is relating to contract law, and other is law of tort. Contract law, according to contract law, auditor is having two contract with the client. One is express contract or written contract. That is what? Letter of engagement. Letter of engagement was auditor formal appointment letter to agree term of audit engagement with the client. In this letter of engagement, there are some terms written. What are the management responsibility? What are the auditor's responsibility? What the work auditor need to perform? And both management and auditor have to perform according to these terms mean letter of engagement. If one party breaching any of the term of letter of engagement, other party can sue for damages. This is written contract, express contract. There is an implied contract as well. What is implied contract? That is to maintain confidentiality. Though it is not written, but it is implied. If client is providing detailed information, they are providing access to the records, so auditor will keep those confidential information with himself. He will not disclose those confidential information for personal advantage or advantage of other party. And if auditor breached confidentiality and client suffered any loss, auditor will be liable to pay damages to the client. Though it is not written, but it is implied. The main topic that we are going to cover, professional liability, is of law of tort. Law of tort means liability to third party. Who appoints the auditor? Shareholder. If due to negligent work, auditor opinion proved wrong, auditor is always liable to pay damages of shareholder whatever they lost. But on your opinion, there are some other stakeholders who are making their decision based on your opinion. Prospective investors, not shareholder, prospective investors. Bankers, they are approving loan based on your audit opinion. Supplier extending credit limit based on your audit opinion. Customer placing bigger order based on your audit opinion. Whether auditor is liable to those other third parties or not. Auditor will be liable to those third party by meeting three conditions. Shareholder is always liable. But for other third party, whether he is liable or not, he will be liable by meeting three conditions. What are the three conditions? Number one, duty of care was ought. Number two, breach of duty. And number three, financial loss was suffered as a direct breach of duty. Duty of care was ought. What does that mean? If before expressing the audit opinion, auditor was aware that third party is taking a decision based on audit opinion. This means before signing report, auditor was aware third party is also relying on my opinion. So auditor will be liable for third party. If before signing audit report, auditor was not aware about third party that he will make a decision based on my opinion, so then auditor will not be liable for that. This means in court, that third party has to prove, like I informed the auditor before signing the report, I am also going to take a decision based on your opinion. Then this condition will fulfill. Second, there is breach of that duty, mean auditor work is negligent. That other party has to prove I lost due to auditor negligent. Mean he has to prove auditor work was not performed as per standard. He expressed wrong opinion. If auditor proved like I performed everything according to standard, and my opinion is according to the evidence based on standard-based procedures, then his work is not negligent. So first, that party must inform the auditor before signing the report that he is going to rely on audit opinion. Second, that party has to prove auditor work was negligent. And third, that third party has suffered financial loss due to auditor negligence. If he suffered any of the reputational loss, then auditor is not liable for bearing reputation loss. Because financial loss, auditor can pay, okay, this was your financial, this was your investment that you lost due to my wrong opinion, okay, that's fine. But other than financial loss, that cannot be determined properly, or it is not liable. If that party loss is not due to auditor negligence, is due to his own any stupidity, even then auditor will not be liable. In that party has to prove, I suffered this financial loss due to auditor wrong report, wrong opinion. If that loss is due to his any other negligence, mean that party negligence or stupidity, not due to auditor wrong opinion, then auditor will not be liable. So for third party, auditor will be liable by meeting these three conditions. Duty of care was out. In auditor was aware before signing the report, like third party is going to rely on my opinion. Auditor work is negligent, meaning breach of duty. And other third party has suffered financial loss due to auditor negligence, not due to his own stupidity or any other reason. Now to explain these three, we are having some cases. The first case we are having of 1990 Caparo case. In Caparo case, auditor opinion proved wrong due to his negligent work, and third party file a suit against the auditor. But that party failed to provide proof like auditor was aware before signing the report. So that's why in Caparo case, auditor was innocent, because first condition was not fulfilled. Then comes another case, ADT versus Binder case of 1995. ADT versus Binder. Here Binder, Video Binder is audit firm, video. This audit firm, Video Binder, they audited their client Britannia Group. And this Britannia Group was going to be acquired by ADT. Audit work was completed. Before signing the audit report, there was a final clearance meeting of Britannia Group management, and ADT were also there. Audit report was not issued yet, not signed yet. But before signing, ADT asked the binder whether you will stand on your opinion that you are going to make. Meaning they were aware auditor is going to sign opinion in favor of the company. So they asked auditor whether you will stand on your opinion, mean this will be your final opinion. Auditor reply to ADT was yes. This means audit report was not signed yet, but auditor was aware. If they are asking whether you will stand on your opinion, this means they are going to take decision based on the audit opinion. Afterward, ADT bought the Britannia Group. They made the investment based on audit report. Auditor opinion proved wrong due to his negligent work. So auditor was held liable because first condition was fulfilled. And auditor had to pay how much? 70 million pound in out of court settlement. The original case was for 100 and above, but in out of court settlement, they had to pay 70 million because they were held liable. Then there comes Law Society versus KPMG case of 2000. In this case, it was decided for regulatory bodies, legal bodies, auditor will always be liable. Either those three conditions fulfilled or not. For regulatory bodies or legal bodies, along with shareholder, auditor will always be liable. Then there comes another case of Bannerman case 2002. In that Bannerman case, it was decided auditor will be liable towards a close stakeholder of the company. Either those conditions are fulfilled or not. Towards close stakeholder, auditor will always be liable. What are close stakeholder? Who are reflecting in financial statement? Bankers, suppliers, bigger customers. Because through audit, auditor is always aware about this. If bank delaying loan approval, they are waiting for audit opinion. If supplier delaying credit, extending credit limit, they are waiting for audit opinion. If customer is going to make bigger order, but they are delaying, they are waiting for audit opinions towards close stakeholder. Auditor is always liable. But if auditor want to limit its liability towards particular stakeholder or towards shareholder only, he need to include other matter paragraph in the audit. If we haven't included other matter for limiting liability, for close stakeholder, auditor will also be liable along with the shareholder in case of negligent reporting. And through this other matter paragraph example, like for limiting liability, auditor can use other matter paragraph. This other matter paragraph is also called Bannerman paragraph in this case, because this was decided in Bannerman case. Towards close stakeholder, auditor is liable in case of negligent reporting. If he want to limit his liability towards particular stakeholder, he can limit by including other matter paragraph in the audit report. So professional liability, in case of negligent reporting, whether auditor is liable to any party, if he is liable, to whom he is liable. So there is two types of liability according to statutory law and common law. According to statutory law, there comes civil and criminal liability. And according to civil and criminal law, by law, auditor is an officer. And if an officer is misreporting, providing wrong information, signing false accounts knowingly, he will be in imprisonment up to 7 years. Second, according to common law, under common law, there comes two contract. One is contract law and one law of tort. According to contract law, we are having two contracts with the client. One express written contract, that is letter of engagement, is to agree term of engagement with the client. And both parties have to perform relation with each other according to those terms. If any party breaching any of the term, the injured party can claim for damages. And implied contract, we are having implied contract with the client to maintain confidentiality. And if we are breaching confidentiality and the client suffer any loss, auditor will be liable for that loss. But the main topic that we are covering this professional liability is law of tort, liability to third party. In case of negligent reporting, whether it is liable to third party or not, auditor will be liable by meeting three conditions. Duty of care was off, breach of duty, financial loss suffered as a direct breach of duty. In Caparo case, the first condition was not fulfilled. Auditor was held innocent. ADT versus Binder. First condition, all three conditions fulfilled. That's why auditor had to pay out of court settlement. Loss society versus KPMG. Auditor is liable for legal bodies, regulatory bodies. And according to Bannerman case, auditor is liable for close stakeholder. But he can limit his liability by including other matter paragraph in the audit report. Let's move towards another topic. Methods of limiting liability. Methods of limiting liability. There are mainly four methods of limiting liability. I mean, how auditor can limit his liability. One is called statutory cap. That is called proportionate liability. Third one is called limiting liability partnership, LLP. And fourth one is called indemnity insurance. Statutory cap. At start of the audit, auditor and client have defined a cap. Cap mean upper limit, maximum limit. Mean if auditor work proved negligent, how much auditor maximum pay damages to the shareholder. And this normally multiple of audit fee, either he will pay double of audit fee, multiple of 5 of audit fee, And this is decided before starting the audit. But it's between auditor and client. For third parties, there is no cap. It's between auditor and client. Whatever the loss shareholder is suffered, he will pay the amount that was decided before. Proportion liability means through this auditor can proportionate his liability, mean to whom he will be liable by including other matter paragraph. Or he can say whatever the loss is due to my negligence, that auditor will pay. Whatever the loss due to your stupidity, that you will pay. In that case, auditor need to prove this loss is due to my negligence and this much loss is due to their own stupidity, their own investigation. Normally, in fact, not normally, audit firms are registered as a partnership business. Firm cannot be registered as a company. Audit firm always registered as a partnership. They perform as a partnership. That's why there are partners, senior partner, engagement partner. It is legally required. They cannot be registered as a company. Company cannot audit other company. They are registered as a partner. And in partnership, partner's liability is what? Unlimited. In case of losses, their personal property can be sold to pay off business debt. In sole trader and partnership, owner's liability is what? Unlimited. In company, owner liability is limited up to the amount of share investment. So if you want to protect yourself, because you cannot register audit firm other than partnership business, so there is option you can register your firm as a limited liability partnership. Limited liability partnership mean in case of wrong reporting, you will pay damages maximum up to the investment mean asset of the partnership business. And what are the assets of partnership business? Table, chairs, AC, some stationery, nothing else. But if you have registered your firm as LLP, sometime good corporate client hesitate to become your client. You cannot attract good client because you have registered your firm as LLP. Why you have registered LLP? This mean might be you do not perform work properly. But this is a method. There is a fourth method, indemnity insurance, mean taking insurance of the firm's services. From where? From insurance company. In case of negligent report, you need to pay damages to the client. Who will pay damages? Insurance company, not auditor. Because you have taken insurance. But if you have taken insurance, ultimately you need to pay annual insurance premium. The taking of this indemnity insurance is not to protect the auditor, is to compensate the client. If you have performed negligent work, though you are not paying damages, but you will be facing some issues, some investigation from your body. Why you haven't performed according to the standards? If you are not following standards, body could cancel your licenses. An auditor is not protected through insurance. Client is compensated. Auditor will be facing disciplinary action from their professional body in case of wrong work proved. This indemnity insurance is of two types. PII, professional indemnity insurance. PII stands for professional indemnity insurance. And FGI, fidelity guaranteed insurance. This PII insurance that is covering civil claims. Civil claims mean if auditor work proved negligent due to error, while FGI will cover criminal claims. Criminal claims mean if auditor work proved negligent due to fraud. And if your work proved negligent due to fraud mean criminal claim and you have insurance of PII, then insurance company will not pay damages. Pay damages to insurance company, you must be having FGI, and normal firms cannot get this FGI insurance from the insurance companies. Only reputed firms is having FGI. And in FGI, there are high insurance premium as compared to PII. So there are 4 methods through which auditor can limit its liability in case of negligent work. Statutory cap, the maximum limit we have set with the client, but with the client only, not third party. Proportional liability, auditor can proportion to whom he is liable using other matter, or auditor can pay liability according to his negligent reporting, not the complete amount of loss by the third party. LLP, auditor can register the firm as LLP. So the liability is limited up to the amount of assets of the firm. While indemnity insurance, auditor can take services insurance. But indemnity insurance is not to protect the auditor, is to compensate the client. Auditor will be facing disciplinary action in case of negligent reporting from his body. And insurance is of 2 types. PII, professional indemnity insurance, that covers civil claims, while FGI, fidelity, a guaranteed insurance, that cover criminal claims. There is one more topic, misconduct. Auditor should avoid misconduct. If he is committing misconduct, your professional body will take action against you. Might be they can cancel your registration. What is coming into misconduct? Obtaining money or goods by false pretenses, by providing wrong information, signing wrong statements, signing wrong reports. Forgery. Forgery mean scheming and leading, mismanaging accounts. Theft. You are conducting audit of a client, and the client was having a high value inventory but smaller in size, and you took the inventory. Nobody is seeing, there is no camera, you put it to your pocket. That is theft. Dishonesty mean you are not becoming honest with the client, like you are disclosing their confidential information to your family members or to other parties for their benefit. And possibly disorderly behavior due to intoxication. In case of drunk, you are misbehaving with the client. You are slapping the client. So that is what misconduct that we should avoid. If we are found guilty of misconduct, we'll be facing serious action from our professional body, ACCA, could be cancellation of our registration forever. Because we need to maintain the repute, respect of the profession. Be professional, behave like professional. So there is another topic called expectation gap. What is expectation gap? Difference between public perception and auditor's true responsibilities. Like public perceive, auditor prepare financial statement. Auditor implement internal control system. The figure in financial statements based on estimate judgment is of auditors. No, this is company management estimate judgment. They prepare financial statements, they implement internal control system. Public perceive, if auditor is expressing opinion, he is providing guarantee. No, he is providing assurance, even less than 100% assurance means reasonable assurance. Public perceive, auditor check 100% transactions. No, auditor obtains sufficient appropriate audit evidence mean based on sample work rather than 100% testing. This is what expectation gap. And there are three types of expectation gap: communication gap, performance gap, responsibility liability gap. Communication gap between public and auditor to responsibility. That auditor covers by including management responsibility and auditor responsibility paragraph in the audit report. Like we have audited the financial statements, we have to check all the transactions, and we are providing a reasonable assurance. Performance gap is relating to auditor as well as general public. General public think like auditor is providing an opinion on all the information available in the annual reports. No, we are providing opinion on the financial statements rather than other statements. That's why for other statements, we include a paragraph other information. Responsibility gap is a misconception in auditor mind. He think his responsibility is to check only the financial statement. He need to take evidence only of the financial statement. No, he's having a responsibility relating to other information in the annual report as well. He think he is liable to only shareholder. No, he will be liable to third parties in case of negligent reporting. If he want to limit liability, he can include other matter paragraph. If it's haven't included, in case of negligent, he will be liable towards third party as well. So communication, public and auditors true responsibilities that we cover through including management responsibility, auditor responsibility paragraph. Performance gap relating to auditor misconception. He need to perform, he need to check only financial statements. No, he need to check other information as well. Liability, responsibility is not only responsible for shareholder, he is responsible for close other stakeholder as well. We have finished this chapter. Before moving towards this question, let's revise some topic relating to AA, F8. In F8, Mike, we have studied about our sales system. What documents company prepare in our sales system, how we can perform substantive procedure of sales system. Let's revise that. If company is receiving order from the customer, company prepare a document called sale order. And company keep this sale order document in sale order records. Why? If there is no record of sale orders, could be some orders missed to deliver. If company is keeping record, this means company is aware, okay, this order we need to proceed, we need to make delivery. They can check which order has been fulfilled and which order still pending. And when they are sending goods to the customer, they are preparing a document called dispatch note, also called GDN, good dispatch note. And company prepared 2 copies of GDN. In fact, 3 copies. 2 they keep in their record, 1 for customer record. But what happens? They send 2 copies of GDNs to customer along with goods delivery. 1 copy customer take in his record, and second he sign and return. That signed copy company keep in record, mean this is a proof customer have received the goods. So signed copy of GDN from the customer, company keep in record. 3rd copy they send to accounts department so that they can receive payments against that. And after GDN, against GDN signed copy, company update the inventory movement, stock movement, where in PIR stands for perpetual inventory record, mean that a file or folder where company record inventory, that is called PIR. And after dispatch note, company prepare a document called sale invoice. One copy company sent to the customer, request for payment, one they keep in their record. Against sale invoice, company record accounting entry in a sale day book. Sales credit, receivable debit. And they update ledger. Individual ledger mean receivable ledger. And they update sales account. They update VAT account that you are collecting from customer and you'll pay to HMRC, output VAT, input VAT, output VAT. And they prepare control account. Control account means combined ledger of all the receivables. So this is the way company record sales. What documents they prepare? Sale order, dispatch note GDN, sale invoice, day book, and ledgers. And when company receive cash from the customer, they record that receipt in a daily receipt list. These are the receiving during the day. And they update ledger, cash debit, receivable credit, where they record update cash in cash book. And they update what receivable ledger. Whenever any entry is going into receivable ledger individually, it's adjusting to the combined ledger of all receivables control account as well. So this is the way company record sales. If we are going to audit sales, performing substantive procedure, mainly we need to verify three assertions. One is occurrence. Other is completeness. And the third main assertion that we perform according in sales system, that is cutoff. What does mean by occurrence? Occurrence mean if sale is recorded here, we need to see that sale has actually been occurred. It is not fictitious. It is not overstated. It is not duplicated. How we can verify? We'll take a sample of sales ledger balances and we'll inspect with relevant sale invoices to see sale is supported by invoices or not. If there are relevant invoices available, this means the sale has actually occurred. It's not fictitious. If there are no invoices available, this means the sale has not been occurred. This is fictitious, overstated, or duplicated. And then we take a sample from invoices and trace backward to the GDNs to see whether there are relevant dispatch notes also available. If dispatch notes are available and there are invoices and then sale recorded, this is genuine sale. Suppose there are invoices but not dispatch note. This means invoices has been created fictitious to record fictitious sale. And then we take a sample from GDN and trace backward to the order to see relevant orders are also available. And if all these backward documents match with each other, this means we have concluded sale occurrence is okay. We can take sample from dispatch note and trace to PIR as well. Inventory movement is also recorded. This means for to verify occurrence. Why we are performing occurrence? To check overstatement of sale. We trace document backward or forward? Backward in the sales system from where sale ledger balance towards originating document means sale order. Are you with me? Completeness mean we need to check whether sale is completely recorded, not missing, not understated. Incompleteness is for understatement, while occurrence is for overstatement. Sale is completely recorded, not missing, not understated, and for that we will trace a forward. We'll take a sample of sale order and check whether there are relevant dispatch notes available. We'll take a sample of dispatch note and check whether there are relevant sale invoices available. And then we will take a sample of sale invoices and check all invoices have been recorded into ledgers. This means sale is completely recorded, not missing, not understood. Even we can check from dispatch note to PIRs, inventory movement is completely recorded against dispatches as well. This means occurrence is to verify overstatement, and we perform backward matching. Completeness is to verify understatement, and we performed forward matching. Are you with me? Cutoff. What does mean by cutoff? To see whether transaction have been recorded in the correct period or not. Mean December sale is recorded in December, and next year January sale is recorded in next year January, not in December. Suppose company have received order on 28th of December. Company delivered goods on 5th of January. Where sale should be recorded in December or January? January. This means we need to see what period these dispatch notes are. Sale must be recorded in that period. And for that, what we will do, we will take a sample of last week of December dispatch notes. We'll compare with their relevant invoices and ledger balances to see sale is recorded in December only. Because these cutoff errors happen in last week of current year and first week of next period. Then we will take a sample of first week of next year, mean January. Of what? Dispatch note. They are dated of January. Now we will match with invoices and with the ledger balances to make sure the sale has been recorded in January only rather than December. Because what date the dispatch note is, sale must be recorded in that date ledger. This means for cutoff, we perform backward matching or forward matching. Forward. From where we will take the sample? Dispatch note. Traced with the invoices and the ledger balances to see sales and receivables have been recorded in their correct period only. So what we have learned, for occurrence, we need to perform backward matching. And we should know about the sequence of document. Ledger balances behind invoice, behind dispatch note, and behind orders. For completeness, we need to perform forward matching from originating document, sale order, towards dispatch note, towards invoice, towards the ledger. And for cutoff, we need to take a sample of dispatch note of last week of current period and first week of next period. Match with relevant invoices and ledger balances to see sale is recorded in their correct period according to dispatch note. This is sales system. Now, if we try to discuss about purchase system. So this sale order will become what? Purchase order. Because when we are placing order, we are preparing one document, purchase order. And when we are receiving goods, there is no dispatch note, there is delivery note. Delivery note that will come with the delivery, we will call it a GR and goods received note. Instead of sale invoice, we will be having what? Purchase invoice. And we will record accounting entry in purchase day book. And then we will update the ledger, not receivable, payable ledger, and in-person ledger like purchase account, VAT into VAT account that we're going to recover from HMRC, and combined ledger of all payable ledgers, that is control account. Simple. And when we will pay money or receive money, payment, we'll update what? Cash book, cash credit, payable debit. Is that? So sale order, purchase order, dispatch note, receive note, purchase invoice, sale invoice, receivable, payable, sale, purchase. But in purchase system, there is one more document before purchase order. That is for purchase requisition. What is a purchase requisition? Authorization for purchase. Approval for purchase from departmental head. So that ordering department cannot place order for their personal use goods. Only those goods must be ordered that are having requisition, mean approval from the top management. Purchase requisition purpose is to control business liabilities. And they will see whether these things is important for business to order, then they will issue requisition, okay, go order. If you are buying unnecessary goods, you are not controlling business liabilities. Is that? In purchase system, we need to verify these assertions for occurrence to see whether purchase is overstated or not. So we'll take a sample from purchase ledger balances to invoice, from invoice to GRN, from GRN to order, and order to requisition. If all previous documents available, purchase is genuine. It occurred. It's not fictitious. It's not overstated. But the main thing in purchase is what? Management try to understate purchases. So we need to verify completeness. Completeness means purchase is completely recorded, not missing, not understated, and for that we need to perform forward match. Cutoff from where? Cutoff from GRN. Company placed order. Company placed order on say 28th of December. They received goods on 10th of January. Purchases of December or January? January. So we'll take sample of GRN of last week of current period mean December and first week of next period mean January, and match with the relevant invoices and ledger balances to make sure purchases have been recorded in their correct period according to GRN. So for occurrence, we perform backward matching from ledger onward towards originating document. For completeness, we perform forward matching from originating document towards ledger. For cutoff, we perform forward matching from note to invoice and then ledger. Is that? We are having 16 minutes. Whether we should go for covering question or no, covering question or no. Okay, we will cover this question next lecture. This is a long question requiring more than 15 minutes. So see you next class. Tomorrow we are having class 2:30 to 5:30. See you next class.
Thank you, sir.
Yeah. I need to conduct classes as per timetable. They have given a timetable based on other subjects as well. So it's better if you move towards according to timetable. Probably on 20th, no, not 20th. Probably on 27th of January. I'm traveling outside. So that's why we will cover that class in previous week. Like on 18th and 19th, we'll be having two classes. One for the covering of 27th class. I'm trying to complete the syllabus till mid of February. So that will be having at least 2 weeks for me. Next week, we are having one mock as well. Next week, I'll inform. Mock will be based on these two topics, ethical and other professional issues and audit report. No. Just there will be two questions of 25 marks each. Yeah. I'll check. I'll check. Could be I'll share with you and you attempt by yourself and send me the answers in any of the Word document, what we will discuss. But tomorrow we are having class. Next week also we are having two classes Saturday, Sunday.